Gold and silver come back from their sell-off, but will they stay volatile? Gold was on track for its biggest one-day gain since November 2008 on Tuesday morning, following a rollercoaster move that sent the precious metal from a peak of $5,500 an ounce down to 4.4 at one point on Monday. A market that was long considered boring has become a conduit for volatility. But why? Mikhail Zverev is a fund manager at Amati Global Investors. Mikhail, do you expect these wild swings in gold to continue?
They might do. There's clearly a lot of fast speculative money, a lot of retail money in precious metals. The underlying source of this volatility was this roller coaster of emotions around debasement trade associated with the independence of the Federal Reserve in the U.S. We had in the run-up to the nomination of Kevin Warsh, which obviously is yet to be approved, we had this concerns, Jerome Powell, criminal investigation into his conduct, Lisa Cook, another board member, there's a lawsuit against her. It was a genuine concern in the market that the Fed independence is at stake. As a result, the dollar was weak. Expectations of interest rates cuts, maybe aggressive beyond the need of the economy, were there, and that drove the metals up, and the momentum got jumped on by speculators and retail investors as well. Then Kevin Warsh's nomination was reassuring. He may be politically opportunistic and sort of signaling that he'll be in favor of easy monetary policy, but he's past his credible, responsible individual. He's been, if anything, a monetary hawk in the past, and hence we had the reversal. But we still have his nomination and approval process. Anything can happen. The one thing I would say, and I'm stealing the thunder of my colleagues who run our commodities fund, our strategic metals fund, and know the space a lot better. I share their view that underneath this speculative behavior, there's a genuine long-term bull market in commodities. We need a lot more metals in a lot more places, industrial metals, to reindustrialize the Western economy, to build out energy and computing infrastructure. So look out for fundamental long-term bull cases through this noise.
Let's talk about AI then, Mikhail. We're in the middle of a crucial season for big tech earnings. They've had a mixed reception from investors so far, and later this week we have Alphabet and Amazon coming up. Is this record capex convincing shareholders?
Like you said, it's a mixed result so far. For the two companies that reported very mixed results, Meta, very significant increase in capex guided for the next year, but they also performed really well in terms of revenue growth, and they connect the two. They say we are doing better in revenue because we target adverts to audiences better. We engage our audiences better with our content. So AI works for us to make our business better. It's hard for an outsider to judge how much of that is cause, how much of that is consequence, but that's definitely a narrative that lands well. Microsoft so far failed to demonstrate incremental, significant monetization of the AI investment. The cloud business is growing really well, but it hasn't surprised investors in the positive. So that's why they've been weak.
Alphabet's up tomorrow. What are you expecting there?
Substantial capex bill, I think. But market will be looking out for, we've seen Gemini, their model family, doing really well. This narrative that Google is a net loser from AI from a couple of years ago is gone. They are very much an equal player, leader in some benchmarks, and they also lead in terms of audience and infrastructure. So they have a huge installed base, if you like, to deploy AI on. So market will be looking on any signs, any data points they can share that says that they're perpetuating their leadership, as we move from the search era into the AI era, that they still have a chance to be our gateway into the internet, so to speak.
One question at the moment, Mikhail, is over whether chip makers can keep up with demand for semiconductors that are powerful enough to fuel AI. Reuters has reported that OpenAI isn't happy with some of NVIDIA's latest chips and it's looking around for alternatives. Should investors be cautious about the chip makers?
There are different chip makers that are keeping up with the demand to different degrees. So NVIDIA remains the dominant leader. In fact, I think Sam Altman had tweeted something recently or published on X saying, no, they are very happy with NVIDIA, expect to be their largest customer for a very long time. TSMC has been and continues to be a bit of a bottleneck in actually being able to manufacture those chips. And in the last set of results, just recently, the management is saying, okay, we need to accelerate capex to serve this accelerating demand. The new emerging area of critical shortage is memory chips. We've long held the view that memory is the cement that AI is built from, and suddenly we have this massive acceleration of demand and 100% increase in prices people are talking about, and even more so on the spot market. So Samsung, SK Hynix, and Micron, which are basically triopoly running the memory market, are making hay and expanding capacity significantly.
That was Mikhail Zverev of Amati Global Investors. Don't forget, you can watch more videos on Reuters.com.